Have you ever been hit by underpayment, estimated tax penalties, or interest? Or are you worried about how much you should be paying in your estimated taxes each quarter? We've got the rules. We've simplified them for you so that you can approach this with a knowledge to keep you away from taxes and to reduce the stress level in your life. I'm going to give you the 3 best rules to use so that you know how to reduce or eliminate interest and penalties. And if you're a business owner, I'm going to give you an additional item that's going to allow you to really run your business for success, increase cash flow, and reduce any interest or penalties. Rule number 1 that you need to know about is when it comes to actually filing your return April 15th or before, you only actually have to have paid in at least 90% of your current year's tax liability. You can write a check for the additional 10%. So if your tax return is variable based on your business income or maybe capital gain income, remember, estimated taxes only have to be 90% of the liability for you to be able to avoid interest and penalties. The second thing that you need to know about your income tax returns is what we call the prior year exception. So let's assume that you have a very variable business or you've sold a lot of stock this year and going to have a significantly higher income this year versus last year, and you're worried about your estimated taxes. The good news is you only have to pay in from an estimated tax standpoint 100% of last year's tax or 110% for those earning more than $150,000 a year. So if your tax last year was $20,000 and you anticipate tax for this year to be $50,000, your estimated taxes only have to be either that $20,000 or $22,000 in estimates, which your estimated taxes can come from 2 different sources, W-2 withholdings or estimated taxes that you make on a quarterly basis. So the prior year exception is a very easy way to eliminate the angst when it comes to filing your returns and to eliminate interest and penalties from underpayment. The third way to really reduce any estimated tax interest and penalties is referred to as the annualized income exception. Let's assume you sold your business in the fourth quarter for a large profit, or you sold a lot of stock in the fourth quarter. You can use a quarter by quarter calculation so that if you didn't know a lot in the first or second or third quarter, you're not required to have paid in estimated taxes for those quarters. You would then focus strictly on that fourth quarter and have a calculation done to say, hey, I earned all my money in the fourth quarter, then my estimated tax payment would be due January 15th instead of pro rata through the year. We use this a lot when we see income earned in the back half of the year versus the beginning of the year to eliminate those pesky interest and penalties that can be charged by the IRS. Now, I told you there would be the bonus number 4, which I love for business owners. Let's assume your business income is always variable year to year. And estimated taxes are going to A, take money out of cash flow, and B, you don't know whether you're going to actually owe any money or maybe the amount of money that you're going to owe because it's going to be based upon profits. So one thing that you can do is the fourth quarter bonus payroll. We see a lot of time that business owners will pay themselves a small salary throughout the year, knowing come to the end of the year, they can do a calculation of what they would actually owe in estimated taxes. They pay themselves a bonus payroll and withhold all of the payroll as taxes. For calculation purposes, the IRS looks at withholdings for W-2 to assume to be made pro rata over the year. So any monies paid in a bonus payroll in December are actually assumed to be paid pro rata throughout the year. It's an easy way to jump over the estimated tax penalty hurdle for you. Now, obviously, the downside to that is if you're paying an excessive amount of salary, you will be subject to the Social Security taxes that are there. But by paying yourself a smaller salary than you normally would and bonusing it out in the end of the year, you're going to pay yourself the same total that you normally would. You're just paying it out in different increments. I hope this video was helpful. If you liked it, please subscribe to the channel for future videos.